Factories will halt. February 14th, Shanghai premium hits $54 per ounce, while COMEX bleeds inventory, while Beijing locks export permits, while $22 trillion in Chinese savings stares at a collapsing Yuan, 3 refineries, 14 days of notice, 1 medal. The question isn't whether they're coming. The question is whether there's anything left when they arrive. Welcome to Currency Archive. If you've been in the markets long enough to remember when financial news actually meant something, when analysts did their homework instead of reading teleprompters, then you're in the right place. We don't chase headlines here. We follow the money trails mainstream media won't touch. If that sounds like the kind of intelligence you've been searching for, the subscribe button is right there. 1 click, takes 2 seconds. And do me a favor, drop a comment below. Tell me where you're watching from. New York, Texas, maybe overseas. I read every single one. Let's get into what's really happening. The Yuan is collapsing. Not slowly, not gradually. Fast enough that Beijing's State Administration of Foreign Exchange held 3 emergency meetings in January alone. $22 trillion sits inside China's domestic financial system. Savings accounts, corporate treasuries, wealth that took decades to accumulate. And right now, that wealth is watching its purchasing power evaporate at a rate most Western analysts are not fully grasping. When a currency loses value this quickly, people move. Institutions move faster. The pattern is not new. Anyone who studied the 2015-2016 Chinese capital flight event knows exactly what happens next. Back then, the yuan dropped 6% in 6 months. Chinese citizens and corporations pulled $1 trillion out of the country in 12 months. They bought real estate in Vancouver, they bought treasury bonds, they bought gold. But something different is happening now. The velocity is different. The yuan has fallen 11% since October 2024. That is nearly double the speed of the 2015 crisis. And this time, the Chinese government has closed many of the exit doors that were open before. Real estate purchases abroad now require approval from 3 separate government agencies. Moving money through Hong Kong banks triggers automatic reporting to mainland authorities. Cryptocurrency exchanges operating in yuan pairs face systematic shutdowns. So the $22 trillion is trapped. But it is not sitting still. Capital always finds a path. When obvious routes close, money flows through the cracks that remain open. And right now, one of those cracks is silver. The Shanghai Gold Exchange tells the story. This is where Chinese buyers access precious metals legally, with government approval. The price differential between Shanghai silver and London silver is called the premium. Normally, this premium runs between $0.50 and $2 per ounce. In January 2025, the Shanghai premium hit $54 per ounce. Let that number settle. Chinese buyers are paying $54 more per ounce than Western buyers. That is not a premium. That is panic buying disguised as market activity. Analysts at the Shanghai Metals Market published internal data in late January. Corporate silver purchases by Chinese manufacturing firms increased 340% year over year. Not for production, for treasury holdings. A solar panel manufacturer in Jiangsu province bought 2 million ounces in December. Their actual manufacturing requirement for the quarter was 380,000 ounces. The remaining 1.62 million ounces sits in their corporate vault. They are not alone. Electronics manufacturers in Shenzhen, battery producers in Guangdong, semiconductor fabricators in Shanghai. The pattern repeats across industrial sectors. Companies are buying multiples of their actual production needs and storing physical silver as a yuan hedge. This behavior is rational. Chinese corporate treasurers are not speculators. They are risk managers operating inside a system where currency controls limit their options. When moving money abroad becomes nearly impossible, buying a physical commodity that holds value internationally becomes the logical alternative. The State Administration of Foreign Exchange knows this is happening. They are watching the same data. But here is the critical insight most analysts are missing. Beijing is not stopping it. Why? Because blocking corporate silver purchases would require admitting the yuan's instability is severe enough to warrant hard asset flight. That admission would accelerate the very crisis they are trying to contain. So the government is caught. They cannot stop the buying without triggering worse panic. Meanwhile, the buying pressure compounds. Chinese import data for December 2024 showed silver imports reaching 520 tons. That represents a 280% increase from December 2023. And these are just the official numbers. Unreported imports through Hong Kong gray market dealers add an estimated 30% on top of official figures. The math becomes uncomfortable quickly. If Chinese demand continues at current rates, the country will import 6,200 tons of silver in 2025. Global mine production is approximately 26,000 tons annually. China would be absorbing nearly 24% of worldwide production for non-industrial purposes. But the real pressure point is not production. It is refining. Silver must be refined to investment-grade purity before it enters financial markets. Global refining capacity is concentrated. Switzerland, the United States, China, and Australia control 73% of worldwide refining capability. And refineries operate on tight schedules with limited surge capacity. In mid-January, 3 major refineries issued 14-day notices to clients. These notices stated that delivery timelines for new orders would extend from the standard 5 business days to 18 business days minimum. Translation: the refineries are running at maximum capacity and falling behind. When Chinese money starts chasing a physical commodity and refining capacity becomes the bottleneck, something breaks. Either prices spike to ration demand or supply chain seize. And right now, both are happening simultaneously. The factories are next. 3 phone calls. And that is what it took for a procurement officer at a mid-sized electronics manufacturer in Germany to realize the silver market had fundamentally changed. First call, his primary supplier in Switzerland. Delivery timeline extended to 21 days. Previously, it was 7 days. Second call, his backup supplier in the United States. No availability for spot purchases under 5,000 ounces. Contracts only. Third call, a commodity broker he had worked with for 8 years. The broker's response was direct. If you do not have contracted supply locked in right now, you're going to have a serious problem in March. The procurement officer hung up and immediately called his CEO. The factory uses 12,000 ounces of silver monthly for specialized circuit boards. They had 18 days of inventory remaining. This is not a hypothetical scenario. This conversation happened on January 28th, 2025. The company's name is withheld, but the situation is confirmed through multiple supply chain sources. And this company is not alone. The global silver refining system was never designed for what is happening right now. Total refining capacity sits at approximately 1.2 billion ounces annually. Under normal conditions, the system operates at 75-80% capacity, leaving room for seasonal demand fluctuations. But current throughput is pushing 94% capacity. Refineries are running extra shifts. Maintenance schedules are being delayed. And still, the backlog grows. The concentration of refining capacity creates a structural vulnerability that most market observers overlook. 4 countries control nearly 3/4 of global refining capability. When demand surges simultaneously across multiple regions, there's no spare capacity to absorb the spike. Switzerland processes roughly 380 million ounces annually through facilities operated by 3 major refineries. The United States adds another 290 million ounces. China refines approximately 250 million ounces domestically. Australia contributes 140 million ounces. The remaining 140 million ounces comes from smaller facilities scattered across 15 countries. When Chinese buyers started pulling physical silver in volume during Q4 2024, Swiss refineries were the first to feel the pressure. COMEX deliveries rely heavily on Swiss refined product. As Chinese demand diverted Swiss output toward Shanghai markets, COMEX delivery timelines began stretching. December 2024, average COMEX delivery time was 5.2 days. January 2025, average COMEX delivery time reached 14.7 days. By mid-February, some delivery requests were being quoted at 23 days. This matters more than price. When delivery timelines extend beyond 2 weeks, industrial users lose the ability to manage inventory on a just-in-time basis. They must either carry larger inventories or risk production interruptions. Larger inventories mean more capital tied up in raw materials. For manufacturers operating on thin margins, this creates immediate cash flow pressure. Some cannot absorb the cost, so they start making decisions. The 3 refineries that issued 14-day notices in January were not making casual announcements. They were sending a strategic signal to their client base. Secure your supply now or accept rationing later. One of those refineries is located in upstate New York. The facility processes approximately 45 million ounces annually, primarily for industrial customers in the electronics and solar sectors. In a standard year, the refinery operates 1 shift Monday through Friday, with occasional Saturday operations during peak seasons. In January 2025, the facility ran 3 shifts, 7 days per week. Despite the increased hours, order backlog reached 11 days. The refinery management sent a memo to major clients on January 19th, stating that any new orders placed after February 1st would be fulfilled on a capacity available basis only. Translation: priority goes to existing contract holders. Spot buyers get whatever is left. The breakdown in physical arbitrage reveals the severity of the situation. Under normal market conditions, if silver trades at $30 per ounce in London and $35 per ounce in Shanghai, arbitrageurs would buy in London and sell in Shanghai, pocketing the $5 difference. This arbitrage activity keeps prices globally aligned. But when the Shanghai premium hit $54 per ounce, that arbitrage broke down. Why? Because there is no available physical silver to buy in London and ship to Shanghai within a time frame that makes the trade profitable. The metal exists, the price differential exists, but the refining and logistics capacity to execute the arbitrage does not exist. This is not a price problem. This is a flow problem. Industrial silver consumption runs approximately 620 million ounces annually. Investment demand typically adds another 240 million ounces. Total annual demand sits around 860 million ounces, while mine production delivers roughly 830 million ounces. The 30 million ounce deficit is normally covered by recycling and above-ground inventory drawdowns. The system works when flows remain balanced. But Chinese industrial buyers are now purchasing silver in volumes that blur the line between industrial consumption and investment hoarding. When a solar manufacturer buys 4 times their production requirement and stores the excess, is that industrial demand or investment demand? The classification matters because it changes how analysts model supply-demand balances. And right now, the models are breaking. COMEX registered inventory dropped from 76 million ounces in October 2024 to 41 million ounces by late January 2025. That is a 46% decline in 15 weeks. Registered inventory represents silver available for immediate delivery against futures contracts. When registered inventory falls while delivery delays extend, it signals that physical supply is not keeping pace with demand. And when that happens in a market where industrial users cannot substitute alternatives, factories start making contingency plans. Some of those plans involve temporary shutdowns, because running a production line without secured input materials is a faster path to bankruptcy than halting operations until supply stabilizes. The question is not whether disruptions are coming. The question is how many factories will halt before the supply chain rebalances. And rebalancing takes time. A customs official in Shenzhen noticed something unusual in December. Silver shipments arriving at the port were not being routed to manufacturing districts. They were going to government warehouses in the Futian district, warehouses typically used for strategic commodity reserves. The official mentioned this to a colleague over lunch. The colleague told him to stop asking questions. 3 weeks later, the customs database showed those specific shipment records had been reclassified. The destination codes were changed. The tonnage numbers remained, but the receiver information now listed generic industrial end users instead of the specific warehouse addresses. Someone wanted those movements hidden. This is how institutional silver accumulation actually works. Not through press releases or official announcements, through quiet procurement programs that leave barely visible traces in trade data, through reclassified shipment records, through purchasing authorities that operate without public disclosure requirements. The Chinese government does not announce when it is stockpiling silver, but the fingerprints are there for anyone trained to read import-export patterns. China's official silver imports for Q4 2024 totaled 1,340 tons, according to customs data. But when analysts cross-reference this against export data from Switzerland, Australia, and Mexico, the 3 largest silver exporters to China, the numbers do not match. Switzerland reported 890 tons of silver exports to China in Q4. Australia reported 510 tons. Mexico reported 340 tons. That totals 1,740 tons. The 400-ton discrepancy represents approximately 12.8 million ounces. Where did those 400 tons go in the official Chinese data? One possibility: government purchases are being separated from commercial imports in internal accounting systems. The customs official sees the shipment arrive. But when the data gets compiled for public release, certain transactions get filtered into categories that do not appear in standard commodity import reports. This is not speculation. This is pattern recognition based on how Beijing has managed strategic stockpiling programs for decades. In 2003, China began accumulating gold reserves without public announcement. The world did not know until 2009, when the People's Bank of China casually mentioned their gold holdings had increased from 600 tons to 1,054 tons. 6 years of buying. Zero transparency. They are using the same playbook with silver. But unlike gold, silver has industrial applications that make government stockpiling strategically different. China manufactures 78% of the world's solar panels. Silver is essential for solar cell production. Each panel requires approximately 20 grams of silver. Chinese government targets call for 400 gigawatts of new solar installation capacity by 2026. That requires approximately 45 million ounces of silver annually just for domestic solar production. If global supply chains become unreliable, having domestic silver reserves becomes a national security issue. So Beijing is building a buffer, quietly, systematically. Export permit restrictions implemented in December 2024 revealed the government's hand. New regulations require Chinese silver exporters to obtain approval from the Ministry of Commerce before shipping silver abroad. The application process takes 14 to 18 days. Previously, export permits were automatic for registered companies. The effect was immediate. Chinese silver exports dropped 67% in January 2025 compared to January 2024. China is not a major silver exporter by global standards, but it does export refined silver to Southeast Asian electronics manufacturers. When those exports disappeared, Thai and Vietnamese factories scrambled to secure alternative supplies. They turned to COMEX and London markets, adding unexpected demand pressure exactly when refining capacity was already stretched. This is strategic resource management. Beijing is tightening outflows while increasing inflows. The net effect is domestic accumulation without explicit stockpiling announcements. Meanwhile, corporate behavior in China mirrors government strategy. In January, a battery manufacturer in Dongguan purchased 3.2 million ounces of silver through Shanghai gold exchange contracts. The company's annual silver consumption for battery production is approximately 900,000 ounces. They bought 3.5 years of supply in 1 month. When asked about the purchase, the company's CFO stated it was a strategic treasury allocation to hedge currency volatility. Not a production input purchase, a treasury decision. This distinction matters. When corporations start treating industrial commodities as currency hedges, they change their buying behavior. They stop purchasing based on production schedules and start purchasing based on availability and price expectations. And they stop selling excess inventory back into the market. Under normal conditions, manufacturers maintain lean inventories. When production slows, they sell excess material to free up capital. This recycling creates secondary supply that helps balance markets. But when companies are hoarding silver as a Yuan hedge, they do not sell during slowdowns. They hold. This removes a traditional supply buffer from the market, exactly when that buffer is most needed. COMEX registered inventory tells the story from the Western institutional side. Registered inventory represents silver stored in COMEX-approved warehouses that is available for delivery against futures contracts. Eligible inventory is silver stored in approved warehouses but not available for delivery. It belongs to private owners who are holding it off market. In October 2024, COMEX had 76 million ounces in registered inventory and 198 million ounces in eligible inventory. By late January 2025, registered dropped to 41 million ounces, while eligible increased to 223 million ounces. What does this mean? Silver is flowing into COMEX warehouses, but owners are designating it as not for sale. They are storing it in approved facilities, but they are not making it available for delivery. This is classic pre-shortage behavior. Institutional holders are positioning physical silver inside the system, but keeping it off the market. They are waiting. CME Group, which operates COMEX, raised margin requirements for silver futures contracts twice in January. Margin requirements increased from $8,500 per contract to $14,000 per contract. This makes it more expensive to maintain speculative paper positions. The CME does not raise margins randomly. They raise margins when they see delivery pressure building or when they want to discourage excessive speculation. Either way, the margin hikes signal that exchange management sees stress in the market. Institutional money managers are reading these signals. Hedge funds that traditionally trade silver through paper futures are increasingly requesting physical allocation. One London-based fund managing $2.3 billion in commodity exposure sent a memo to clients in mid-January stating they were converting 40% of their silver futures positions to allocated physical holdings. Though a memo cited delivery risk and counterparty exposure as primary reasons for the shift. Translation: they do not trust paper claims when physical supply is tight. The $100 per ounce price level is the institutional trigger point. At $100, thousands of COMEX futures contracts become profitable enough that holders will request physical delivery instead of rolling contracts forward. Current COMEX open interest represents approximately 670 million ounces of silver. If even 10% of contract holders request delivery at $100, that is 67 million ounces. COMEX registered inventory, 41 million ounces. The math does not work, and institutional players know it. That is why they are positioning now, before the crowd realizes what is coming. A solar panel factory in Brandenburg, Germany, sent an internal memo to senior management on February 3rd. Subject line: Production Halt Scenario Planning. Silver Supply Risk. The memo outlined 3 operational scenarios based on silver availability over the next 90 days. Scenario 1 assumed normal supply chain function. Scenario 2 assumed partial supply disruptions requiring production slowdowns. Scenario 3 assumed complete supply interruption requiring temporary facility shutdown. The CFO asked the procurement team which scenario they should plan for. The procurement director's response was direct. Plan for Scenario 3, hope for Scenario 2. That conversation represents where industrial silver consumers are right now, not panicking, but preparing for disruption as the most likely outcome rather than the worst case possibility. The timeline matters because multiple catalysts are converging in a compressed window. February through March represents peak refinery maintenance season. Refineries schedule major equipment servicing during these months because industrial demand typically softens after year-end production pushes. Maintenance takes facilities offline for 7 to 14 days. But 2025 is not following typical patterns. Demand has not softened. Refineries are running at maximum capacity with growing backlogs. Yet maintenance cannot be postponed indefinitely without risking equipment failure. A Swiss refinery that processes 120 million ounces annually had scheduled maintenance for February 10, 24. Management faced a decision: proceed with maintenance and lose 14 days of production during a supply crunch, or delay maintenance and risk an unplanned equipment failure that could take the facility offline for months. They chose to proceed with maintenance. The cost of potential catastrophic failure outweighed the cost of planned downtime. That decision removed 12 million ounces of refining capacity from global markets for 2 weeks. And this facility is not alone. 4 major refineries have scheduled maintenance between February 8th and March 15th. Total capacity offline during this period, approximately 35 million ounces. Now layer in Chinese New Year dynamics. Chinese factories traditionally shut down for 2 weeks, surrounding the Lunar New Year holiday. In 2025, the holiday falls on January 29th, with factory closures extending through mid-February. During this period, Chinese silver fabrication and manufacturing slows dramatically. Investment demand, however, does not slow. Chinese buyers continue accumulating silver, but domestic production of finished goods decreases. This creates a temporary supply absorption event. Silver flows into China, but less silver flows out in the form of exported manufactured goods. The net effect is Chinese markets pulling physical metal during a period when global refining capacity is simultaneously reduced by scheduled maintenance. Then comes Indian wedding season. India is the world's second largest silver market. Cultural traditions involve gifting silver during weddings, and the auspicious wedding dates fall primarily between April and June. Indian silver imports typically spike 40 to 60% during this period. In a normal year, global supply chains accommodate this seasonal pattern. But 2025 has already stressed the system before Indian seasonal demand even begins. Indian importers are aware of the supply situation. Premiums in Mumbai have already risen from typical levels of 0.80 per ounce to 2.40 per ounce in late January. Indian dealers are pre-ordering inventory earlier than usual, which pulls forward demand that would normally hit in April. This compounds the February-March supply pressure. Meanwhile, Chinese solar production targets create sustained industrial demand that is not seasonal. It is structural. China's 14th five-year plan mandates 400 gigawatts of new solar capacity by 2027. Meeting this target requires domestic solar panel production to increase 28% annually. Each gigawatt of solar capacity requires approximately 112,000 ounces of silver. The math: 45 million ounces annually just for Chinese solar manufacturing. This demand is non-negotiable. The government has tied solar production to national energy security and decarbonization goals. If silver supply becomes constrained, Chinese manufacturers will pay whatever premium is necessary to secure material. They cannot miss production targets. Beijing has multiple policy levers to ensure domestic manufacturers get priority access to silver. Export restrictions are already in place. The next step would be explicit import prioritization, where government-approved manufacturers receive preferential treatment in customs processing and warehouse allocations. If China implements import prioritization, global markets will see Chinese buyers securing available supply before it reaches COMEX or LBMA warehouses. This would accelerate the registered inventory depletion already underway. Currency intervention scenarios add another variable. The People's Bank of China has several options to stabilize the yuan. They can raise interest rates, sell foreign reserves to buy yuan, or implement stricter capital controls. Each option has consequences that ripple through commodity markets. If Beijing tightens capital controls further, Chinese buyers will increase silver purchases as one of the remaining legal methods to move wealth out of yuan-denominated assets. This would intensify buying pressure. If Beijing sells U.S. treasuries to support the yuan, global bond yields could rise, potentially strengthening the dollar and putting downward pressure on commodity prices in dollar terms. But this would not reduce Chinese physical demand. It might actually increase it, as Chinese buyers see silver becoming cheaper in dollar terms while their yuan continues weakening. Either way, currency intervention does not solve the physical supply problem. It only changes the price mechanism through which the shortage expresses itself. For business operators dependent on silver supply chains, the strategic decision framework is straightforward. Companies using silver as a production input face 3 choices: secure contracted supply now at current prices, wait and hope spot markets remain accessible, or develop contingency plans for production interruptions. The cost-benefit analysis favors immediate action. Locking in supply through forward contracts eliminates uncertainty. Yes, contracted prices may be higher than current spot prices, but the cost of production shutdown far exceeds the premium paid for supply security. A circuit board manufacturer in Taiwan ran the numbers in late January. Securing 6 months of silver supply through forward contracts would cost an additional $340,000 compared to spot purchasing, but a single week of production shutdown would cost $1.8 million in lost revenue plus customer penalties. The decision was obvious. Treasury managers at larger corporations are evaluating silver exposure from a different angle. For companies with significant silver inventory on balance sheets, the current market dynamics represent both risk and opportunity. If supply tightens further and prices spike, inventory values increase. But if prices spike so high that customers cannot afford finished products, demand destruction could offset inventory gains. The 90-day window matters because this is the time frame where current trends either stabilize or break. Refinery maintenance will be completed by mid-March. Chinese New Year factory restarts will normalize production by early March. Indian wedding season demand will clarify by late April. If supply chains can absorb these overlapping pressures without breaking, markets will stabilize at higher price levels but maintain function. If supply chains cannot absorb the pressure, the result will be delivery failures, contract defaults, and production shutdowns. The institutional behavior visible in market data suggests major players are preparing for the latter scenario. Registered inventory drawdowns, margin hikes, delivery delays, and corporate hoarding all point toward participants positioning for disruption rather than stability. This is not prediction. This is pattern recognition. When refineries extend delivery timelines from 5 days to 23 days, they are telling the market something specific. Physical supply cannot keep pace with demand at current prices. When Chinese corporate treasurers buy 3 years of silver supply in 1 month, they are telling the market something specific. They expect prices to rise or availability to disappear. When COMEX raises margins twice in 3 weeks, they are telling the market something specific. Delivery pressure is building, and they need to discourage speculative excess. These signals are not subtle. They are clear warnings that the silver market is approaching a structural inflection point. The timeline is measured in weeks, not months, and the factories are already planning for halts.